Buyer demand shoots up despite a volatile rate environment. Average sale price was down ever so slightly. The median stayed the same, but compared to last year, the numbers aren't great. What does this mean for buyers? What does this mean for sellers' equity? We'll get into the numbers in just a second. I'm Ron Milligan with RE/MAX Select, and as usual, I have our weekly market trends for you. This is for the full metro area from Southwest Washington down to Portland and all of the bedroom communities. Let's get into the numbers. The inventory of homes available for buyers to purchase went up just a smidge. It was up 0.5% versus the previous week. That was a gain of 17 extra listings for buyers to look at in our market. Not a whole lot. We seem to be continuing to bump along the bottom, waiting for our spring buying season to kick in and get some more listings on the market for buyers to choose from. I did see some national numbers on inventory, and they kind of mirror what we've been experiencing in Portland Metro, in that over the last 20 years, the inventory of homes available for buyers to purchase right now is the third lowest that we've seen in the last 20 years. Only 21 and 2022 had fewer homes available for buyers to purchase. And if you check out this chart here, going back to 2017, that's as far as they went. The same holds true here. It's the third lowest inventory of homes available for purchase. So why is this inventory so low? Well, part of the reason is something that we've discussed several times in our market updates, which is that a lot of folks are just locked into their homes with their really, really low interest rates. They've got an interest rate that starts with a 2 or a 3. Maybe they refinanced into that great rate. And for them, if it's time for them to move up to the next house, and they have to do so to a higher price point with a much higher interest rate, they either can't do it or they simply don't want to do it, and they're just going to wait it out. And that's keeping the inventory low. The other thing that's keeping the inventory low is something that we haven't talked about for probably six months or so, which is the housing shortage in the United States. Take a look at this graph here. These are estimates from some of the bigger players in the game on where we are as far as housing shortage goes. So what this is a comparison of typical household formation versus new construction, so homes that have been completed. You can see that the range is pretty wide there. Realtor.com says that we're 5 million homes short. Bank of America 4 down to Moody's or Morgan Stanley at 2 million short and Moody's at 1.6 million short. Every once in a while I'll catch Ivy Zellman, who is another one of these analysts. She'll say it's as low as 1 million. The truth is probably somewhere in between. Why is this the case? Well, you can see why in this chart here, which comes from the Census Bureau, and it shows new single-family homes completed over the decades, going back to 1970. And if you average all these numbers together, you've got that midline there, and you can see that for the last 14 years, builders have been building a less than average number of homes per year. Since about 2012, they have been ramping up, but at a rate that is still below the annual typical household formation. Reason for that is a lot of builders got burnt during the great housing recession of 08, 09, and 10, and 11. And in fact, a lot of builders went into bankruptcy and just left the business. And since then, they've been very careful about getting overbuilt. Maybe in this last year, in this last frenzy of 21 and 22, they got a little bit over their skis. And we've heard some analysts say that we're probably going to spend the first half of this year working through what builders probably overbuilt. And by the middle of the year, by probably the end of July or end of June, beginning of July, that most of that inventory should be absorbed. Builders are probably going to go back to being very cautious at that point, at least until we get a little bit of normalcy in the market. The number of new listings is up slightly, was up 2% at 461 versus roughly the same time period last year. 552 new listings hit the market. Price reductions continue to go down. We're seeing fewer and fewer of those week after week. The new pendings, so the number of homes that went under contract this last week, went way up. It was up by 15% versus the previous week. Here's a great chart showing you back to October what the numbers for new contracts were week after week. And you can see that this is the highest number we've seen since October. Not a surprise though, because as we've been talking about, interest rates have really been the driving factor behind buyer demand. And of course, in October, November, December, interest rates were extremely high, at least compared to what we have right now. The number of homes sold is up slightly, only 2%, but keep in mind that's for homes that went under contract like 4 to 6 weeks ago. Average days on market is going down. Average was 45 last year. At this time it was 19. The median days on market also going down, 13 this week. Last year at this time it was 5. The average sale price did only go down by 1%. It was a slight decrease versus the previous week. But when we're comparing to what was going on last year at this time, we're down 6.3%. Median came in at 525, no change from the previous week, down 6.3% versus the median roughly the same time period last year. It's one of those rare times when the average and the median are the same. And basically what this means is the house that's selling this year is selling at 6.3% less than what it would have sold for last year at this time. So that's 6.3% depreciation in 1 year compared, looking at the year over year. Looking at the average sale price this year versus last year, we're gonna see some ugly numbers. I suspect we're gonna see some really ugly numbers going forward, at least until May, June, July. The reason for that is last year at this time, if you remember the 15th of March last year, the Fed met and raised their Fed funds rate for the first time in forever, and it caused this knee-jerk reaction in the market. Rates had been in the low 3s, and then they shot up, just bypassed the 4s and went into the 5s. And when that happened, it did knock a whole ton of buyers out of the market. I mean, just at that time, we went from 1 week where we would put a property on the market, it would have 35 showings over the weekend, and it would end up with 10, 12 offers by the time everyone had written their offers. Then right after that, those showing counts went way down from 35 down to like 7, for example, and then maybe we would get 1 or 2 offers that weekend and it would go under contract, still over asking price because a lot of agents and buyers weren't aware that the market had changed that much and they were already preconditioned to go into their offer situations hot and heavy, going way over asking price and waiving all sorts of inspections. That just goes to show how important it is to have an agent who knows what's going on in the market, just like all the agents in our office here at RE/MAX Select. The other thing that happened is a lot of buyers were driving to get under contract before rates went even higher. So we continued to have a pretty good market through the balance of March, through April, and through May. In fact, through April and May, we had really low inventory. Properties were still selling really quickly. The days on market was really low, and the average sale price continued to rise. I went through my notes from last year, and I did see where we topped out. So the highest average sale price we saw in our sampling was on May 31st at $667,111. So $667,111. Right now we're at $572,226. Last year at this time, roughly the same time period last year, the average sale price was just above $610,000. So going forward, prices got up above that 625 mark. They pretty much stayed above that mark for the balance of the time period between now and May 31st. And on May 31st, they hit that high of $667,111. And then from that point, the average sale price receded, but it did not get below the $600,000 mark until September 20th. That was the first time since May 31st that the average sale price dropped below $600,000. What we're seeing this year, with the average sale price are continued gains, but much more modest than what we saw last year. So I expect as we go through the next couple of months, the average sale price this year is going to be very modestly rising versus last year, which was rising at a much faster rate. And that by the time we hit May, we may see as much as a difference in the average sale price week after week after week at 10%. Maybe even a little bit more. So As always, I'll keep an eye on those numbers and let you know what we're seeing. The last of the trends that we're going to be looking at are the bank-owned and the pre-foreclosure short sale properties that are on the market. Both of them went up just slightly compared to last week, from 50 to 53 for bank-owned, and then I think it was from 19 to 20 on the pre-foreclosure or short sales. This week I did do something, I went a little bit further and I just looked at, of those 53 that are bank-owned, 30 of them were active and 23 of them were under contract. I was surprised to see that 23 of those were already under contract. I was expecting that number to be a little bit lower, mainly because what we've been seeing on the market is that homes that need a lot of work are taking longer to sell, or they're having to really discount off the asking price to get them under contract. So that's probably what's going on with these bank-owned properties. So of the 20 short sales, 7 of them were still active. 10 of them are in the status we called short sale pending. That's a status where a buyer's made an offer on the property, the seller's accepted it, and then the seller and their short sale negotiator have gone to the bank that holds the loan on that home, and they're negotiating with the bank to see if the bank will let the property sell for less than what's owed on the note. What can happen during that time period is the bank will start negotiating with the buyer. They'll get to hopefully some agreement, and then they'll move on to pending status towards closing. And of those 20 short sales that we have, those pre-foreclosure homes, only 3 of them are in that pending status where the bank and the buyer have agreed to a number. So I had 2 more things I wanted to talk about this week. One is a question that keeps coming up from my clients. So I wanted to provide a little bit of clarity on where residential interest rates, mortgage rates come from. As you may or may not know, yesterday the Fed board met again, and they did raise their Fed funds rate by another 0.25%. So they increased that Fed funds rate by 1/4 of a point. That, however, does not have a direct influence on what happens with residential mortgages. That number is more tied to credit card debt, auto loans, boat loans, any sort of revolving debt. That's what that number regulates. The residential mortgage rate has not a direct tie, but a correlation to the 10-year treasury. I found a great chart here that illustrates this, where you can see that top line is the 10-year treasury yield, and the bars below that are what the 30-year fixed rate mortgage has been going back to just about the start of the year. So you can see that there is a correlation between the 10-year treasury and the 30-year fix. On this next graph, based on information data from Freddie Mac, you can see that there is typically a 1.72% spread. So 172 basis points is the phrase that they like to use, spread between what the 10-year treasury is and the 30-year fixed mortgage. So there's a real strong correlation. Again, it's not a direct cause and effect relationship, but there's this really strong correlation. And when the number goes above that 1.72 spread, that usually means that there's some volatility and some uncertainty in the market, which is getting baked into that spread between the Treasury and the 30-year fix. Here's a graph showing the current spread between the Treasury and the 30-year fixed based on data from Wall Street Journal. So what that tells us is there's a lot of risk and uncertainty built into that spread between those two numbers. That banks are very concerned and they're being very cautious. But it also tells us that when things start to settle down, there's a lot of space, there's a lot of room for the interest rates to reduce. I did check interest rate numbers this morning, as I do every day. Wells Fargo was coming in at 6%. They had been at 6.25 2 days ago, 5.875 yesterday, and this morning they were at 6%. However, I did notice that the 10-year Treasury has been trending down. Today is March 23rd, and just before I started this video, I did check the 10-year Treasury. It was trending down at that point and trading at just below 3.4%. One thing that really caught my eye this week was an analysis of nationally where buyer demand has been landing based on increasing and decreasing interest rates. In this chart here, you can see that they're saying, that range between 6 to 6.5% produces good buyer demand. You go above that 6.5% mark, up towards 7%, and that produces limited buyer demand to weak buyer demand once you get over 7. I would say for our Portland market, we need to drop it down about 0.5 point, and that our market really starts to kick into high gear once rates get below 6%. Once they get above 6%, 6.25, 6.5, then we start to experience limited buyer demand versus the good buyer demand that they're showing here. So I would just drop everything down about 0.5 point and say, you know what, that's kind of what we've been feeling in the Portland market. Well, that's what I have for you today. I hope you found that information enlightening and helpful. And I'm always thankful that you watched the video to the very end. Thumbs up to you, and please give a thumbs up to me. And if you haven't followed the channel, please do follow the channel. And as always, if you know of someone who might find this information helpful or informative, share this video with them. I would absolutely love that. And let me say in closing, as always, all real estate is local. We have markets inside markets inside markets. If you're curious about what's going on in your specific neighborhood, your neck of the woods, what's going on with your home equity, just reach out to us and we are more than happy to help you out with those questions. We'll see you next week.